Live. There you go.
You know what? Thank you. That's a great way to start. You know, we've all been in our homes, condos, cottages, wherever you may be in the world today. As long as you're safe, you're keeping yourself safe is the most important thing to do. For the speakers that are still arriving, don't. What I'm doing to you, I'm just moving you to the attendee status until time comes up. So everyone, good morning. We're going to get started. I know we're going to get a lot of people trickling in. I'm so pleased this morning to get the day going for all of us with the individual that made it all happen for us. And for me, it's always a pleasure. I never had the pleasure of introducing him. At the last KoreSummit, one of my colleagues had to do it because, well, we'll get into that discussion another time. But it is exciting for me to actually introduce to you none other than Mr. David Weild. He is the former vice chairman of NASDAQ, the father of the Jobs Act, and he worked with many, many others who are going to be here as well today. He's certainly not one person that's taking the full, but this is where it all started. And Regulation A is dear to him and many others as well. And today he is the chairman and CEO of Weild & Co., one of the fastest growing FINRA broker-dealers in the United States. And as he indicated, he has been in isolation at home, self-quarantine, just outside of New York. And I'm gonna let him kick off this morning to get us all started. Let's have some fun.
Thank you, Oscar. I just wanted to wish everybody just good positive vibes. It's going to be a little tough road here, I think, for a lot of people in North America and the rest of the world. And I hope you're all healthy and sound, and your families are as well. I'm a mile and a half from the original epicenter in the New York Westchester area, and actually the man that actually was sort of patient zero for the United States came out of the hospital in the town that I'm in, which is Bronxville in Westchester, New York. Bronxville's Lawrence Hospital. So we've actually had even an 18-year-old on a respirator. So far my family's lucky, but we're seeing obviously other people who aren't. So I just thoughts and prayers out to everybody who is challenged in these tough times. I don't know how you want to handle the deck, Oscar.
You can just share your screen right there, my friend.
I can. Okay, so I'll put it. I sent it to you last night, and I didn't know if I was sharing it or not. So let me see if I can. Give me 1 second, and
not a problem. While he's getting set up, there's a lot of people still coming in, so which is good. Thank you, everyone who is still trickling in this morning, including our speakers who are wondering why their cameras are not working yet or their audio. That will turn on automatically when your section of the panel comes up. So this morning we're getting everything started with the keynote delivered by Mr. David Weild. So here we go, everyone.
There we go. Okay, I think I got it. Okay. Let me know. Do you see this? Do you see Regulation A plus, a framework for success?
Yes, we do.
Okay, terrific. We're in business. Just a brief intro to Weild & Co. We're an investment bank. We have investment bankers and placement agents in 17 states in the District of Columbia, where people can work anywhere, office anywhere. We're platform based, and we're advocates of remote collaboration. The objective ultimately is to see if we can't virtualize a bulge bracket investment bank in the cloud by aggregating vast numbers of independents to collaborate to get more accomplished, right? To get more things done, because as anybody that's been in the investment banking business knows that every deal is a project. It needs a different kind of project team, people with different industry or product expertises and distribution. And so people really, by coming together, get more things done. And so far, we're seeing some pretty fair evidence. It was founded in August of 2016. I thought it would be helpful to tee off the conference by just going through a little bit of a background on Regulation A+. While I probably get too much credit for being the so-called father of the Jobs Act, this is what we did do is we wrote a bunch of white papers, thought leadership papers that got picked up in Congress and elsewhere, actually across the globe, that highlighted the decline in the small initial public offering and some other things. And so as a consequence, it opened up a discussion around what should actually be done to resolve this. It's still going on. And so what I like to tell people is probably the biggest contribution of the work that we've done is it changed the discussion, in Washington and across the globe. So all the way back on March 16th, 2011, and I've been testifying in the House a number of times, but this was sort of some of the testimony that we actually did, and I just wanted to kind of give you, to frame what Regulation A+ was, and in particular, I spoke quite a bit and had a hand in a number of the provisions that actually were signed into law with Regulation A+. In fact, so long ago that it was at the time HR 1070, it wasn't even part of the Jobs Act. The Jobs Act was actually an omnibus bill into which a series of other bills that were being sponsored by various other people in the U.S. House of Representatives got rolled into one and delivered to, and got ultimately delivered over to the Senate. And then the Senate made some modest changes in the bill and sent it back for an up or down vote in the House of Representatives and was sent to President Obama's desk to be signed into law. Interestingly, President Obama, had told the U.S. Senate and the Democrats that he wanted this bill. So it was incredibly bipartisan. But the United States stock market, once the envy of the world, suffered a devastating decline in small number of initial public offerings. And our research and analysis of relevant data strongly demonstrated that small businesses and entrepreneurs couldn't access the capital that they needed to create jobs. And so the United States was losing more companies from our listed exchanges than we were replacing with new IPOs. And when measured by the number of listed companies, America's stock exchanges were declining while those of other developed nations were increasing. And so we said it was imperative that Congress, regulators, and stakeholders in the debate evaluate and take action to increase the number of U.S. publicly listed companies as outlined in the Small Business Capital Formation Act of 2011, which was the original Regulation A bill, HR 1070, to increase the ceiling, which is the amount of capital that could be raised to provide a less costly and more effective alternative for smaller entrepreneurial companies that wanted to access the public capital markets. It also would enable smaller growth-oriented companies to access the public market at an earlier stage in their growth cycle. And I think that, as many of you know, the gestation period of venture companies, which at one point was around 4 years, ballooned out to 8 to 10 years. And so this is one of the challenges that we're still, in general, trying to address. So, but if you go back, and I don't want to take too much credit, there are two people that really deserve a worthy mention. The original guy that highlighted Regulation A+ as an opportunity from a legislative process standpoint to open as a path was a gentleman named Steve Mochtinger, along with Bill Hambrecht. And for those of you that are of a certain age, you'll remember the name Hambrecht and Quist. It was one of the so-called four horsemen. Steve Mochtinger had worked at the SEC. Steve was the general counsel at Hambrecht and Quist. He knew of Regulation A+, which at the time was seldom used. And he was the one that wrote the original draft. And then a bunch of us really sort of, picked that football up and ran with it. Bill Hambrecht spoke or testified in Congress while it was still democratically controlled when Barney Frank was the head of the House Financial Services Committee, and then it shifted over and was to Republican control, and it was subsequently picked up by Jeb Hensarling, who was chairman, and in particular, a congressman named David Schweikert, who was the actual sponsor of the original HR 1070 or Regulation A+. David's a Republican from Arizona. He still sits on the House Financial Services Committee. So but the idea was you know, originally the original Regulation A plus, which was limited to about $5 million in proceeds, was enacted during the Great Depression to help the economy by improving small business access to equity capital. So you're seeing a kind of a recurrent theme. And the originally, and this was all the way back to 2011, mind you, in the paper that in our testimony, we said that it was going to drive down costs for issuers by permitting the use of a simpler offering circular for the SEC's review. It would open up the Regulation A exemption to a size that will allow companies to list on the NYSE and NASDAQ and to avail themselves of so-called blue sky exemption, at least on the primary distribution, thus avoiding very costly state-by-state filings. And it would allow issuers to gauge the visibility of an offering by meeting with investors but before incurring the significant costs of an offering, this so-called testing the waters provision. And for those of you that are sort of students of capital markets, you'll see that it was generally broadened, even most recently by SEC Chair Jay Clayton, to include all public companies. They brought it over to Title I of the Jobs Act, which was the emerging growth section of the Jobs Act, and then ultimately made it available to all companies. And I liken that a little bit as a Hail Mary pass, because if you look at the WeWork action, you know, it was really kind of shocking that that Wall Street could go out and try and get a deal done at a $40 billion valuation that subsequently gets recapped at $8 or $9 billion. And I would tell you that because of the degradation in distribution, it's likely that they just really didn't have good enough discussions going on with buy-side investors to really understand where that stock should have been priced. And so I think that I don't want to put, I don't want to give you a sense that I have any specific knowledge, but I suspect that SEC Chair Jay Clayton, by extending these provisions, is basically saying, hey guys, you got to get out there and you got to talk to investors. You got to find out where the market is, you know, so that you can de-risk transactions. We contributed a number of specific Regulation A plus provisions. This is actually from the testimony in 2011, including that issuers file audited financial statements with the SEC, and this is what became Title II, that issuers be required to submit their offering statements to the SEC electronically, that periodic disclosures be determined by the SEC, and that the SEC stipulate so-called bad boy provisions or bad actors to disqualify, you know, bad people from it. And what we were trying to do here, just so you know, is to get an information standard into the marketplace, because, you know, our experience in private markets is that, you know, that companies will disclose the least amount they can many times to get done, and that companies that have to disclose, you know, will have a higher disclosure standard. And markets don't work very well if there isn't an information standard in the marketplace, which is what we were trying to achieve here. This is the slide that kind of catalyzed Washington, and I always repeat it, but this was the drop-off in the small IPO, and you can see that small IPOs were sub 50 million. They fell off a cliff in 1997 and 98, which was in the height of the dot-com bubble. And the reason it did was because we shifted to electronic markets, collapsed trading spreads, and collapsed commissions. And so there wasn't enough money for people to get in and to make markets and support smaller capitalization stocks, which is going to sort of set the stage for a little bit of what I will talk about in terms of news you can use. So, you know, I'd be remiss in not pointing out that there's a recent SEC proposal to take the amount that you can raise under Regulation A plus from 50 million up to 75 million, and to raise the maximum offering amount for secondary sales under Tier 2 from 15 to 22.5 million. This is the one that doesn't require an information standard. I may have confused the tiers earlier, but Regulation CF crowdfunding is also going to be taken up from 1.07 million, which I think was adjusted for inflation. It was originally 1 million to 5 million. Interestingly, that 5 million cap is what was originally proposed in Patrick McHenry. He was the congressman that sponsored the original legislation for Regulation CF. and then it got whittled back down to 2. And then when Professor Jack Coffey from Columbia School of Law testified that he, something to the effect that imagine a bar room filled with, smoke-filled bar room with some character like Danny DeVito holding court over widows and orphans. That was the one thing that the Senate cut back in the draft of the Jobs Act, and it took it all the way back down to 1 million. As it's turned out, I think that there's been, little fraud in that area. I mean, look, small companies have problems at a more frequent rate, but the basic thesis is that we got to get more companies started. And this, and as you can see, the level of sort of desperation. This is U.S. Census Bureau data, 2006 to 2017, and it basically shows the business formation or startup rate in the United States. And dark red is a higher startup rate, and white is a lower startup rate. And as you can see, it's changed massively. And this is kind of the stuff that, in the aggregate, we are advocating to create toolkits to get more capital into smaller companies, because we think that that's the essential and missing ingredient to drive more rapid rates of sort of engineering, scientific discovery, innovation, and solve the great challenges of our time, whether it's new drugs for coronaviruses, it's ways to take CO2 out of the atmosphere to control global warming. I was going to, just give you a little taste. This is the demographic effect, and what you've got there in the arrow, 1990 versus 2020, or 30 years. The arrow is the baby boomer, height of the baby boomer population. But the point I would like to make is as the population gets a little bit older on average, the risk-taking appetite is on average is going to decline. And so that means that, notwithstanding market structure challenges, you've got a population structure which is going to afford less risk-taking capital. So you've got a 1-2 punch going on here, which is less risk appetite with people getting older, and a market structure that doesn't support getting capital into smaller capitalization companies, which I think is one of those things that all of us on this call need to talk to our congressmen and politicians to try and say, basically, hell no, we're not going to take it. We want you to fix these markets to get them to work again. So RegA Plus is a piece of it. Now, one of the things that I wanted to pass along to you is that you get deals done because you have distribution. The problem is that aftermarket distribution in public markets isn't there because of the collapse of trading commissions and spreads. People can't get paid to pick up the phone and market stocks, so they gravitate to self-directed styles, or they go to as individual investors, or they cut the they go to funds. And what we've seen in a lot of the brokerage firms is that more and more brokers are effectively asset managers, and they're taking a percentage of assets and not out there actively marketing ideas. And that's a problem. It's also a problem that everything has become so algorithmically driven, and you see these wild gyrations in markets, and that there's no short protection when you have pre-revenue companies like life sciences companies that somebody can push down and naked short, or not even naked short, borrow stock, drop a bunch, create a downward pressure. And because there's no money in the business of people getting on the phone and countering what's going on and saying, hey, there's no information out there, this is an opportunity to buy this stock, back up the truck, because there's no way for people to make money making that call. It becomes open season on particularly pre-revenue micro-cap companies, which are life sciences and sometimes medical device companies. I mean, obviously, those are incredibly important to the future of medicine. And so, I would say that it's, in my view, it's sort of it's a cardinal sin what we have done to public markets, and at least in the micro-cap area. And I think that we really need to restructure the aftermarket pretty quickly, very quickly here. You can take a Regulation A+ transaction and you can restrict it so that it doesn't trade. Don't be stupid, okay? There's a lot of things that shouldn't trade. You don't want to put a deal into the marketplace that's going to drop like a stone and lose people money. And there are many instances where discretion is the better part of valor. You either don't use it, or you use it in a situation where you can market to individual investors, lock up the stock so that it doesn't trade, and when the company becomes big enough, do an IPO that actually will support itself, okay? So, you know, the objective here is, in this case, is apply Regulation A, where you have a stock which has no dividend to help support it, is not a big, you know, consumer name. So it's kind of almost mad to try and take it, make it trade publicly, restrict it contractually, have public investors on an initial distribution, make it public reporting. That's a benefit. You get the blue sky exemption on the distribution. That's a benefit, but don't let it trade. Or you have to design a security that supports itself. High current return does that, where things become more bond-like, or you grow the company to a size before you list, where you and start trading, where network effects take hold. And you can do a bona fide IPO, which is at least $100 million more. I had this conversation with a couple of guys that were pretty significant. One was David Topper, who ran Equity Capital Markets, the new issue business at JP Morgan. And the other one was a number of years ago with Kevin Cowan, who was the president of the Toronto Stock Exchange. And, both of them came up with numbers and said that for stocks to support themselves, given how efficient the US market had become, that it really needed they thought as much as $400 or $500 million in float value for network effects to take control. So that means that the burden on the company to create aftermarket support if it's going to trade is extraordinary. And you can't go in there as an amateur and expect it to support unless you've got a security that is going to naturally find a market, and you can't delude yourself that it will. I would say, if people have questions, I think my contact information is on the deck. I appreciate the opportunity. One thing I will tell you right now, and I'm going to bang this drum loud and hard, is that we need a different kind of stock market structure for micro cap, small cap stocks that actually creates incentives and allows brokers to get on the phone and remarket, pays people to provide research. In a big seller, no buyer kind of marketplace, there needs to be a way for intermediaries to transact. And if we get that on top of Regulation A+, we're going to do a whole boatload of business over the long run. We're going to build back distribution that supports micro-cap stocks, and that's on the policy-making side. And I think that without that, we're going to be we're not going to fulfill our long-term potential. Regulation A+ is a great tool, a great arrow in the quiver. It has a lot of potential. But if you want to take the potential of it up an order of magnitude, we need a different market structure to allow people to support these stocks once they start trading. Thank you.
Wow, that was pretty amazing. Usually our keynotes with David, we do try to do them in 1 hour. Today, we understand that with the internet, things are a bit different. There's a lot of questions there. So David did mention, yes, the presentations will be available to all of those who have registered. So we'll put a package together for you to be able to download the materials, and of course, the contact details of every one of the speakers that we're going to have today. I want to thank David. It just kind of gets the ball rolling as to what we're about to do here. And obviously, I'm going to be asking our next panel that's coming on here is our panel on the actual legal regulation. So I'm going to be bringing in our next group of speakers here for all of you, so we can get you all set up. And so if you could just give me a little bit okay, so we got number 2, and then of course we are looking for number 3, and there we go. I believe we have all 3 of them on, and they'll turn on their cameras. And so, as David alluded to, the Regulation A+ is exciting. It's got a lot of different pieces to it. That's the reason why today, if you look at the agenda, we've broken it down into bits and chunks for you. And it's important from the legal that we broke it down from an overview So we have these wonderful lawyers who are up very early in the morning out in the West Coast. And of course, Jamie out in Washington. So everybody's up and early for you to get things started. For those who will have questions regarding the regulations, specifically, we will gather the questions for you and make sure that they are answered. We're going to try to see if we can answer them here while we're on stage, or we're going to be able to answer them for you after the event is done. And we will be sending those through with the slides or kind of a Q&A, but we will get you all that information. So without further ado, this morning, I'd like to introduce you to three wonderful, amazing lawyers that we at CoreConnex are excited to be working with. First of all, we have Jillian Sidoti, who is here with her other partner in her firm, Nancee Tegeder. And of course, I hope I pronounced your last name correct, Nancee.
You did it perfect. That was great.
Good, thank you. And of course, Jamie Ostrow as well. So if you want to know about, obviously, Regulation A, you got to talk to the lawyers who are doing it. So we're going to get this panel started. I'm going to be moderating, working with the three of you, kind of getting the process started. Let's carry on from where David started this morning. He was obviously talking about Regulation A. I'm sure there's a lot of people here that, now that we know what it is, can one of you, actually, Nancee, why don't we get started with you? What is Regulation A from the legal perspective and the regulation and what we have in front of us?
Well, I know we just got a little bit of background, so I don't want to repeat too much of that, but very short answer, it's just a way for companies to legally raise money under the Securities and Exchange Commission rules. That's a quick answer. Now we can get into all the technical and what the parameters are within that, but that's the short answer.
Short answer. Wow. Okay. All right. So, excuse me, my throat. Jamie. So within the Regulation A+, we keep hearing, wow, you can raise up to $50 million. So now we start breaking it down from the top level. We're going to break it down to the nuts and bolts of it. And we keep hearing about Tier 1 and Tier 2. Can you talk about Tier 1 specifically? And then I'll obviously go back to Jillian and ask her about Tier 2.
Sure, and I will say that we don't see as much Tier 1, and if you look at the recent SEC report, Tier 1 actually only represents a small fraction, I think about 10% of the money raised under Reg A or something like that. Tier 1, the issue with Tier 1 and why actually CrowdCheck does not use Tier 1 that much or at all is that Tier 1 does not preempt federal regulation, which means that if you're a company looking to use Tier 1, which you would have to actually go to each state depending on where you want to raise and get, and then get kind of like there's like a uniform system, but get questions from each state. And we find the process to be quite cumbersome if you're going to multiple states. Tier 1 allows issuers to raise up to $20 million. And the difference with basically Tier 2 is you don't need audited financial statements. You just need financial statements for the past 2 years. They don't have to be audited. And then the second thing is there's no ongoing reporting regime. That I think are the main, high level differences between the Tier 2s.
But it's interesting to hear you say that, at least from CrowdCheck's perspective, you haven't seen it. And part of it is, if you want to use the regulation in its full force, it's going to prohibit you. Did I get that correctly for everybody else?
Yeah. Oh, sorry.
Sorry. I was going to just quickly say, with the exception of local issuers or companies that are just looking to maybe do almost like an intrastate offering or some specific real estate thing, we believe that for the most part, Tier 1 is pretty difficult to work with. And we think that Tier 2 is actually faster for most of our issuers.
Perfect. And that comes back to you, Jillian. Good morning.
Hi. Sorry for jumping in there. I thought sorry.
Don't worry about it, guys. Okay, ladies, my apologies. The most important thing here is that, look, we're all used to doing it in hotel rooms, sitting down and we can all kind of see, this is new. Webinars are one thing, we're PowerPoint slides. We're here to kind of a discussion. We have a lot of people that are very interested in learning what the regulation is. And you can imagine from a company, the questions they often ask. So, Jamie led us off with Tier 1. Jillian, tell us about tier 2.
So tier 2, like Jamie, we don't do tier 1s either for the same exact reasons Jamie said. I used to do tier 1s way back in the day, actually, even before RegA, the Jobs Act passed. I did what was the old version of tier 1s because that's all that existed back then. And the states themselves are very difficult when it comes to getting your deal through. They'll ask you for what I believe are incredibly unreasonable things. So we stay away from tier 1. I won't even do them. And it's because you have to go through that state rigmarole. With tier 2, not only do you not have to go through that, but you can raise more money. You can raise up to $50 million. And the trade-off is, of course, the audit. You have to get audited financials, which I think is good policy anyhow. You should have financials audited for investors. So they have even if you don't have anything to audit, like I deal with a lot of real estate companies, we probably deal with more real estate companies than any other type of company. And a lot of these companies are brand new and they don't have any financial history. So they're questioning, well, why do I have to do an audit? You're auditing nothing. That's just what the rules are. And so, yeah, you audit nothing. And you spend a little money to audit nothing than spending a lot of money to get the states to agree to allow you to sell in their state.
Well, that's great. So thank you for that overview. So we've talked about the limits of each of the tiers, and but obviously, like any company, okay, so we hear about real estate. So what are the kind of types of companies that can utilize this regulation? There's a lot of mixed messaging out there, depending who you talk to. Some people say it's only for privates, but it's kind of a mix. Nancee, did you want to dive into that one?
Yeah, let me unmute that for you. So I would say the majority of what we focus on at our firm is real estate, but it is not limited to that. It can be basically anything. We've done biotech, clean energy. We call it like a mini IPO. So it is private, but basically anybody who wants to, public or private, can join in and do a Regulation A offering. It's open to anyone.
But on that, is it just restricted to private companies?
No, it could be public or private.
Okay, and which public companies? Are we talking, OTC, NASDAQ, NYSE, or is it just?
As far as who can participate it can be there's no restrictions with it. So you can come, and it can be any type of business as well.
Okay. So any private or public company, but there is one underlying major restriction on this regulation, and that is that the company, I'll ask you, Jamie, the company must come either from US and Canada in order to use that.
Yes.
Did I get that correctly?
Oh, that was a trick question, Oscar.
Well, I don't know.
I missed your leading question.
No, I just want to make sure I got this correct. Jamie, you're on mute, and so it's not, but I just want to make sure for the audience, because we do have a mix of, we have some people here from Singapore, UAE, Kenya, which obviously we're going to have a discussion with them later.
Right.
But the initial regulation was created for private and public companies from US or Canadian domicile. Did I say that correctly?
Yes. You have to be, what's it called? You have to have a principal place of business in US and Canada. You have to be organized also under the laws of US and Canada, right? One of the jurisdictions there. And there also are some companies that can't use Regulation A that we come across sometimes, or we want to make sure that our issuers don't fall into those categories, which include like investment companies, business development companies, and like certain companies like blank check companies. If you just like basically want to go out there and kind of do like a shelf offering, like, here I want to just have some dummy company.
Sorry. You blank check. I mean, the last time somebody wrote me a blank check was, it doesn't happen. What does that mean?
It's basically, you can be a brand new spanking company. In fact, the SEC just put out the statistics for RegA a few weeks ago, and the majority of companies have zero revenues and are pretty new companies. The issue is you need a company that has a specific business plan or purpose.
Okay.
So you can't just be, I want to raise money and then I'll come up with an idea later. You have to actually give details about what the company plans to do.
That's fair. That's fair. I think that's a fair thing. I just, when I hear blanket check, I go, whoa, okay, where do I stand in line? But
well, yeah, and to Jamie's point about the Investment Company Act, like I have had companies that would have fallen in the Investment Company Act, but what you really have to make sure you do is get one of the exclusions, and there's three. One exclusion's pretty much useless under RegA, but there's two other exclusions that you could use, and one's the real estate exclusion, and one's less than 100 investors. And so you could use one of those two exclusions to avoid the Investment Company Act.
Perfect. So, okay, so we've covered the amount, we've covered the tiers, we covered a private or public. Obviously, we'll deep dive a little bit deeper on that. So let's talk about the investor now, Nancee. So obviously, part of the Jobs Act, David has spoken a great deal about this, whether it's in RegA, RegCF, is to allow the everyday American to participate, right? To be part of it. So what is there for them? What safety nets are in? Are there any restrictions as to who can invest, limits and all that?
Right. So, and it's broken up between tier 1 and tier 2. So with tier 1, you don't have that investor requirement, but like Jamie and Jillian were saying, we try and steer clear of tier 1. What we focus on where we do the majority of our work is with tier 2. And so with that one, there are some restrictions with your investors. It's either 10% of their income or 10% of their net worth, whichever is greater. That's the amount that you can invest, but it can be accredited or non-accredited under tier 2.
Okay, so that's and what about the limits though, Nancee? I mean, I'm 18 years of age. I'm legally allowed to invest, right? So I make $50,000 a year. I see an opportunity, at one of the websites or online issuance platforms. How much can I invest in this company? Am I restricted to how much I can?
So the limit is $5,000 at that example for the most.
For the most. Is that because of the income? Is that what it is that's setting the limit, or?
Yeah, so the first thing you want to look at is the 10% of your net income or your net worth. And so you just look at the maximum of that. So with your example, that would be the max. Okay.
So for the investors, pretty straightforward. I mean, obviously, this is where they get to participate and be involved in a company. And if done right, I mean, we'll hear about it later this morning. So, okay, so we talked about the company. And so now let's talk about just high level the process. I mean, you being the lawyers, you get to see everything, right? So I'll start with you, Jillian. You've done a lot of real estate. So what's the expectation from time frame from the minute somebody comes to your door? Hi, Jillian, I want to do real estate RegA. What kind of time frame should they be looking at, and what are you going to need from them to get that started?
Well, actually, if you give me 2 seconds, I got a slide here. I'll show everybody a slide.
Perfect. Thank you.
Hold on.
Can you put it up on slideshow? There you go. Perfect.
Yeah. Hold on. Give me 1 second. I got to scroll through here for a second. All right. That's the rules. Here we go. RegA. All right. So the first thing you really have to do is get your offering together, hire your securities attorney, and what we call testing the waters. And testing the waters is really going out and advertising and seeing if there is interest in your deal. And I will tell you right now, if you aggressively test the waters, the SEC is going to want to know about it, and they want to make sure that you're putting a legend, what is called a legend, which is like a disclaimer on the bottom of that testing the waters. But you can go out, advertise, see if there's interest in your deal prior to actually getting people through the door, and prior to getting approved by the SEC, prior to filing anything with the SEC, you can go out and do that. And I think that's a great thing, because it gives you an opportunity to see if the market's going to actually respond to your offer without spending all this money on attorneys and accountants and things like that. So that's the first thing you want to do. And then the second thing you want to do is get your books audited. We had talked about getting an audit done, and you need a certified auditor. They don't necessarily need to be PCOAB. And that's up to the auditor on how long that's going to take. But if you're a brand new company, it should take no time at all. If you have no revenues, it should take no time at all. And then we're going to submit that to the SEC after we get your offering together, your books audited, put all the exhibits together. We'll submit that to the SEC, and then we're going to wait 27 days. And it's usually give or take 27 days, but what the rule says is 27 days. The SEC gets back to you with what are called comments, and those are just things they're saying, change this, change that. You're going to receive those comments, answer, and you might have a couple of different rounds. And once you get through that, you're going to be qualified. You'll clear those comments, and then that's when you can go out and start raising capital. Now, I've done this in as little as 2 months. So you can get it done in as little as 2 months. However, I tell everybody who comes to me and says, I want to do a RegA, number one, that you better be prepared for it to take 4 to 6 months. That's the first thing. And the second thing I tell everybody is that you better be prepared to do your ongoing reporting requirements. I made the mistake early on with Regulation A and offering that service when the Jobs Act first came out of not making sure there was a strong commitment by the client to get the ongoing reporting requirements done. And I had quite a few of them who, to this day, even though they're like a year out from the reporting requirements, who have not done their reporting requirements. Wow. And I constantly am emailing saying, where's your audit? Where's your audit for this year? Where's your audit for this year? Where's your audit for this year? And that makes me nervous for them. It makes me very nervous for their investors. And then it makes me very nervous for the marketplace. I don't like that. So right at this point, if you're thinking about doing RegA, you better be committed to the process of RegA beyond just getting the initial paperwork done.
Agreed. Thank you, Jillian. You know what? That is one thing that we try to instill with everybody at KoreConnex, and of course the entire ecosystem of our partners. And thank you for that, because we don't often hear about the post other than the company got the money, but yeah. Your commitment to that is not just the money. You got to commit to the SEC. You got to commit to the market ongoing, because otherwise you're ruining it for everybody else. That's the bottom line. Right. You're giving the SEC every reason to shut this thing off, or those who say, look, the scammers are coming. The scammers are coming. So, no, seriously, I mean, look, I've been following David Weild since 2010. I believed in democratizing of capital. I understand the discipline, the responsibility, pre, during, and post. And it is that pre, during, and post. And post is where we're damaging ourselves right now. Not just in Regulation A, we're doing it in Reg CF. Sarah Hanks has spoken tremendously about this. So we can fix it, and we all have a responsibility at the beginning. For all those listening today, the checklist you're getting, it's not for you to pick and choose what you want. It's to make you aware of what you're committing into this whole thing. So Jamie, let me ask you this. I mean, Jillian provided a great overview for real estate. Would you say that outside of real estate, the same process and same time frame would apply for all the other companies? Because I know CrowdCheck has worked with a number of companies as well.
Yeah, no, I think her 4 to 6 month estimate is probably pretty reasonable. That we always tell people, look at that on the long end. Real estate, or if it's a new company, I will say the biggest gating issue we find for timing is the financials. So if you're a manufacturing company who has and I know David is coming to speak next, the accountant. If you have a manufacturing company, it's going to take longer to audit, especially if you've been around for years. And the accountant has to go in and basically count the widgets. Audits can actually the time frame can slide on that. But in general, it takes about a month to get the first set of comments. Then, depending on the depth of the comments or what needs to be changed, going back and forth, maybe a couple of times, hopefully, and then getting qualified. And also the other thing that we do in the process is you also have to send state notice filings near the end of it, because even though Tier 2 is preempted from state registration and qualification requirements, it's not preempted from state notice requirements.
So I'm going to take some questions from the attendees, because one of them is really good. One individual, Darren, is indicating that He wants to have clarity of the principal place of business. He's indicating we have a U.S. company that is subsidy of a domicile in another country. Would the U.S. company be eligible for a Reg A under the regulations? Nancee?
Sorry, I gotta unmute me. So yeah, as long as they can show that they're a US based company and they have their entity domiciled in the US, and that's their principal place of business, then probably that would work. I wanna definitely talk to them to get the details of their business, but generally that should be okay.
Perfect. And Jillian, I got one for you because you answered. So somebody's asking, we are a Canadian public company, and if we do a Reg A and raise up to 50 million, can we get listed on a U.S. exchange?
Oh, that's interesting. You know, I haven't tried getting a Canadian company listed on a U.S. exchange. I can't imagine that you wouldn't be able to. I suppose it depends on the exchange. Personally, and maybe Jamie, they do this. I stopped doing listings, and it was so funny because what David was saying earlier, I wanted to scream at the screen that I agreed with him so much because we stopped doing publicly traded companies. Like we will not. So if you're looking to get listed on an exchange, please go to Jamie because we will not, yes, we will not do your form. I'm just being complete. This is a terrible commercial for my firm, but we won't do the form 211. We won't do it because again, just like I was saying earlier about getting that risky client in that won't do their ongoing reporting requirements, you also have the risky client who comes in and then has a traded company that's a penny stock and is subject to potentials with fraud and things like that. And I just want nothing to do with that. So, you know, that's another thing you really have to think about before you go forward on getting listed. I have done the opposite where I've had an American company get listed on the TSX or something like that. But again, you have to have, and forgive the term, you have to have a real come to Jesus moment before you get listed on an exchange, because once you get listed on that exchange, you as the control person have kind of lost control because this market's going to take over and you can't stop people from selling their stock cheap, from talking about you on the internet, from driving the price down, from having, a lot of volume of trading going on so that you can't raise additional capital after the fact. So I that was a really long answer to a totally different question. So I'm going to stop now.
It's okay.
That's what I'm passionate about.
No. Listen, we're all on the same page. I mean, I'm an advocate of keeping companies private. I believe Regulation A+ is a great regulation to help us grow our companies, make sure we establish great relationships with our shareholders. And as David alluded, when you have the revenues and the valuation to warrant a public listing, that's when you do it. In Canada, I'm a Canadian. When you're raising money, here's what they dangle in front of us. Hey guys, I got $5 million on this CPC and I can get you traded and you can have liquidity for your investors. That's not liquidity, that's disaster. That's all I call it, a disaster. And that's my personal view for any company who is getting publicly traded on a TSXV or CSE. There's nothing wrong with them. It's just that when your company's still trying to figure out how you generate revenue, how you're building your business, the worst place you want to be at is in a public environment while you're building that. You can find shareholders. So I'm talking personal experience, but Jamie, you got put on the spot there, as Jillian said. Is CrowdCheck doing public listings with Reg A?
We definitely will help a company do public listings, but we normally also have, I'll use the same term, come to Jesus moment with our clients, because there are a couple of things that come into play. We look at the cost of ongoing reporting, and as Jillian said, most of our clients, we continue with them and we help them with their ongoing reporting, but the cost of compliance with a Reg A company, let's say, can easily be done probably with less than $50,000 a year, including our costs and helping and including the accounting costs. And a typical registered company, you're talking about $500,000, $2 million potentially of ongoing compliance and regulatory costs. So if our client comes to us and has just started, is trying to raise $3 million, it makes absolutely no sense. We're talking about companies that are much better developed that it might make sense for. And then there's the other thing is, and I know we haven't mentioned it, but I figure I'll mention it for companies, is Reg A is an exemption from registration from the Securities Act. And there are certain things that you might require that you register with you need to register at a certain point, including, Reg A allows you to sell to unlimited number of shareholders, both accredited and not accredited. In certain cases, you might actually need to register, and one of those cases might be if your company gets big enough that you might have to have like a 2-year registration, which means that if you have 50 million in revenues, or if you're listed, you could be a Reg A company and not be a fully registered company, but be on like, OTC like markets, one of the like, OTC pink sheets, OTC QB. But it also means that if you have, let's say, a public float at that point above 75 million, at some point you might actually have to start in the 2-year phasing to get registered. But at a certain point, the companies that have, starting to have that much money, it might be something they want to do.
Perfect. And look, for everybody who is the participant, everybody who's listening in, this is not a doom and gloom. These are realities that you must understand, that you need to come to this prepared. You need to have everything ready. If you want to take advantage of the regulation, there's responsibility you need to take as a company. Some people may think, well, this is gloom. It's not gloomy, it's reality. You can either hear it now or you're gonna hear it when you go and speak to them at a later time. Right now, you're having the pleasure of listening to Jamie, Nancee, and Jillian giving you the real truth, because they're doing these offerings. If you look at all the filings, these names keep coming up all the time, and there's a few other speakers you're going to hear today. So this whole reason for today is to save you the cost and headache of hearing what needs to occur. We're advocates of doing things fully compliant and keep your companies private. There is one question that Jamie, you started, but I'm going to ask Nancee that it came up. So obviously the regulation allows a non-accredited investor to invest. It has limits, of course. So where can this investor come from? Obviously, some of us go, hey, I can sell it globally. There's 4.7 billion people over the age of 18 globally today that can invest. Is that correct? Or am I limited? Or do I need to do other things in order to make sure I can sell my securities globally?
So, and that's a great point. I want to clarify 2 things. So we said it's the issuer that is restricted to the US or Canada. But as far as what you're asking, who can come and invest? Yes, you can go broader than US or Canada. And I say that with caution. There's going to be certain tax withholdings that you're going to have to comply with if you have foreign investors. You would definitely want to do a background check. There's restrictions in some countries where you can't have them. So our recommendation is to restrict that. But if you are looking, we have had some clients from other countries that have US connections, but maybe want to bring in some other foreign investors. And so you just want to be careful on how you structure that, but that is possible.
And we're going to talk about that later today. And Kevin Mullen, I know you got some questions regarding advertising. We're going to talk about that in other panels. Obviously, this regulation does offer a number of ways that you can undertake your offering. But the overview today, now we're going to kind of come to a conclusion on this with this discussion. Obviously, Tier 2 has been limited to $50 million. And the big announcement, as David alluded to, everything's getting increased. So, Jamie, I'll just start with you first. Do you see any ongoing changes from the Tier 2 perspective because the limit is getting increased to 75?
Hopefully the changes will be that we'll have more sophisticated companies or other companies who before didn't think this was a good fit for them because the limit was too low, approaching us or looking to enter the market, which will be great for all market participants to have those companies.
Okay, and Jillian, do you have an estimate? I'm putting all 3 of you. Put your hand up. Do you think it'll happen in the next quarter? Obviously, U.S. is obviously getting ready to stimulate the economy. They did it a couple days ago with the trillions of dollars that are being trickled down to small, medium enterprises. Is this another piece of that puzzle that needs to be triggered that will stimulate and bring additional asset classes to utilize the regulation?
I don't know if necessarily increasing it to $75 million is going to do that. I mean, what we're seeing is like a lot of people, the companies who quote unquote need RegA or that RegA was created for can barely raise the money as it is. And I'm not, I don't mean to be such a Debbie Downer on my own industry, but I have been all morning, which is terrible. But I do like some kind of reality check for all of us. Like we're having a lot of companies out there who go out, they do their offering, and then they raise a modicum of money. They don't raise the full amount. They don't even get close to $50 million. I've only had a handful of companies that have come close to $50 million. And the big, huge darling of RegA early in the day was Elio Motors, and they got $26 million in commitments and ended up only raising $17 million in capital. So I don't know if the raising of $75 million is going to make much of a difference. And I don't know if it's actually going to happen now, because I think the SEC has a lot of other things that they have to deal with. I can't imagine the fraud that's going on right now, as the government is focused on other things and keeping their people safe. So they can't be as on top of probably the new fraud that's cropping up as this coronavirus stuff is going on. I am a depressing person today. I am very sorry.
No, listen. We're not going to look. A lot of the times, people don't want to hear look, all we did was just outline the regulation to people, the good, the bad of it, how to prepare for it, how to get your documents in order. When they go to any of you for advice, I know there's a lot of people asking questions very specific about where you're from, either Singapore, Mexico, Canada, public and private. There's other legal panels, and keep in mind, everyone here that is listening in, the panelists are here to provide you guidance based on their experience, and they can't provide specific advice. Clearly, you must understand that there are no two deals alike. There just isn't. I mean, at KoreConnex, people keep saying, well, you must have seen two that are identical. Yes, the dollar amount, but outside of that, nothing else was the same. The number of shareholders was different. So the reality is we're all trying to provide you kind of an overview. Obviously, this will stimulate a more of an in-depth discussion with them, and you'll have an opportunity we will provide you their contact details so you can contact each of them specifically with your questions, because obviously this is going to be important for you. For those who are looking for, specifically to Canadian companies, we have a panel on that coming up. And for those who are outside of US and Canada, we have another panel that's specifically for the global RegA, because that is, and somebody asked, well, why isn't Mexico part of that, since we're part of the free trade? I'm sorry, the Security Commission, can somebody answer that? Jamie, do you know the answer why Mexico is not included?
I don't know. I haven't looked at that one, but I'm going to guess they probably have a slightly different legal system as far as that's concerned, and they just weren't part of the process.
They just weren't part of the process. Yeah, that's what I figure. I mean, so the real key here is that, look, our goal today from 9 a.m. till 5 p.m. this evening is to bring you the end-to-end, hear it from the experts, and stimulate your mind about how you can fund your company. And it starts right here. So I want you all to know right now, when you contact KoreConnex and you want to schedule a meeting for us to show you what we do, the first thing we're going to send you to is the lawyers. You need to speak to them. The conversation needs to get started with them. The conversation needs to be with them in order for them to help you structure your opportunity. Talking to anybody else is kind of not so much waste of time, but it isn't moving you forward. They're the ones that move you forward. They make sure that you meet all the requirements. So have your business plan ready, have your audit statement, which we're going to have that great conversation next. And then you're going to have the pleasure of meeting these three wonderful lawyers in the US to help you with your capital raise. So I'm going to give you each of you a couple minutes in closing. What would you like to say from, I mean, look inside and look at all the, give me the 2-minute positive note that you've seen, Nancee, from Regulation A Plus since you've been doing it. Legal perspective,
I just think a lot of times we'll have clients come to us and they want to be able to advertise and they want to be able to accept sophisticated investors. And we do a lot of Reg D offerings, and that you can kind of do one or the other. You can't do both. And so RegA has opened up this opportunity for our clients to allow them to do both and be able to raise the money that they're needing to raise for their company.
Perfect. Jillian?
Yeah, so I mean, the thing is, I've seen RegA do some amazing things. I was kind of the Debbie Downer this whole entire time. And that's just because I want really people to have a realistic expectation when they get into this. But with that being said, what really excites me about RegA is that people can now get in on the bottom floor of a really exciting opportunity. I mean, I have one client I'll talk about that is looking to 3D print a heart. I mean, that's amazing. And there's not every day that you get the opportunity to invest in something so exciting and so cutting edge, as just, you know, a person, an individual who doesn't know much about stocks or anything else, but you see that these people are making this effort. And of course the risk factors are incredible, but that are making this effort to 3D print a heart. That's, to me, is just such a great opportunity, not just for the company to grow with the crowd, but also for the crowd to get into such, and by the way, that's not an opportunity. That's not an endorsement to invest. I want to be very clear. But I do, if you don't mind, I'm going to share my screen one more time because I do have something that I can give the audience that might help them with answering their questions. If you just go to helpful chart, if you write in the subject line helpful chart and to an email to crowd@crowdfundinglawyers.net, that will send you this chart. It will explain tier 1 and tier 2. It also explains regulation crowdfunding and Reg D. So you can get that for free. That's helpful chart in the subject line at crowd@crowdfundinglawyers.net. And then here's my personal information in our website. So you can get that there. But I do love RegA. RegA is great. It's a great opportunity. It's a great opportunity for people to be involved, and it's a great opportunity for companies to reach an audience that previously couldn't be tapped.
Perfect. Jamie?
So I was on mute for a second. So I will talk about some statistics, actually, and is how I'll end it. You see, just to give you a sense of how well Reg A has been doing, the SEC released a report in March, and the average, and again, like Jillian said, each issuer is unique, right? Like just because one issuer did something, like doesn't mean, you know, your issuer, your company is going to replicate it. But today, like, you know, since Reg A was revamped in 2015, the aggregate proceeds from tier 2, and I'm only going to do tier 2 because I do think tier 2 makes the most sense. The aggregate proceeds was $2.2 billion raised from 144 companies, of which there was $1 billion raised in 2019 from 39 companies. And that makes the average, so if your company is looking to raise under Reg A, the average raised under tier 2 was 15.4 million. And then the median, if people are statistics junkies, would be 5.5 million for that. So just to know that it's a little bit like, you know, there are a lot of companies raising a little bit, and then there are a lot of companies raising like the higher end, which would be more the real estate companies that we've seen be raising near the maximum of the Reg A.
Perfect. So that was a great way. Personally, for me, what I'm going to say is we're seeing the companies on the other side. We're the post. And I can tell you when it works, there are some companies that really take it to the next level. And we're going to have some speakers today talk to you about the darling of Reg A+. In my opinion, they are the darling because they've gone and done it 3 different times, 3 years in a row. And they have really taken the relationship between their shareholders to the next level. And I think any company that steps into this, not only from the legals, I think Jillian nailed it. You really got to come at it. So CEOs in this session, listen carefully. 1, you need to plan your pre. Pre is getting all your stuff, the legals, the audit, all the people you're going to work with to make you successful. And then you got the during phase where you're legally responsible, you and your team, for what's being said, how it's being presented, and making sure that you're communicating that message. And post, you have an ongoing obligation with your advisors, your legal, your auditors to submit to the SEC and keep that going. But just as important, you now have a new shareholder base that can be fairly significant. It can be 1,000, 10,000, 30,000, 100,000, 200,000. And I can tell you from personal experience, watching it in our own company with our clients, it's exciting. So I believe in it because when it's done right, it is great. I've seen the other side as well, to Jillian and all of you here, that when it's bad, it goes bad really quickly. Because for those who are looking at this regulation, you're raising money from the crowd. I mean, I don't know how you all feel about this, but the crowd is not the same as an accredited investor. This person put in $200 of their money, and they expect to be treated in a certain way. And if you don't do anything about it, they have the power of the internet. The same power that got you the capital, it's the same capital. And this is not about the legals, but that's part of the overall encompassing part. So that's why I'm pumped up about RegA. And and I'm thankful to Jillian, Nancee, and Jamie, who have supported CoreConnex with the clients, and looking forward to the many questions lying ahead. I know there's a lot of other questions here. We're not dodging you. Most of your questions are going to be answered in other panels, but I will say this. So somebody asked, are you recording these sessions? The answer is yes, and it will be available to those who have registered. For those who are asking about PowerPoint, yes, those will be available to you as well. We'll send them out as a package. We will get what Jillian put up there, which was really funky nice. We'll take it from her, don't worry. And we will distribute to all of you who have registered and for this. So Jillian, Nancee, Jamie, thank you so much for
Thanks,
the
Oscar.
session this morning. Yes,
Oscar.
Nancee, the only thing I didn't bring for you was a little dessert. I know that's your favorite thing.
Well, next time we meet in person, we'll do that.
Well, likewise for everyone. So if everyone, thank you, Jillian. I'm moving you over to attendees. Thank you. And in the meantime, for everyone else, I am going to ask you if you can just